Good evening, everyone, and welcome. Welcome to our investment and retirement basic workshop this evening. My name is Georgette Bowman. I'm president of Trenton Alumni Chapter of Delta Sigma Theta Sorority Incorporated. So this evening we have a treat. As you're aware, April is Financial Literacy Month. And we have a workshop this evening that is geared to help us learn how to manage our money, budgeting, saving, investing, and defining your retirement vision. So let's get started and let me introduce you to Kanita Bullock, who is a certified financial planner. She began her career in investment management industry with one of the largest investment firms in the nation, American Funds, also known as Capital Group. And she left that corporate role to help individuals and families and organizations as a wealth manager and retirement plan advisor for Edward D. Jones and Financial Services. She has established the Master Plan Investment Group in 2019 with a mission to serve clients by helping them clarify their financial goals. Anita received her MBA from New Jersey Institute of Technology, where she was recognized as the future role of technology in investment management industry and used this knowledge as the foundation for her business. Kanita is married to Eric Bullock, who is an educator, and they have two daughters, Bella and Madison. And I'm proud to say that she is an active member of the Trenton Alumni Chapter of Delta Sigma Theta Sorority Incorporated, in which she serves as our assistant treasurer and on our finance team and also on our strategic planning committee. At this time, I'm going to turn it over to Kanita Bullock.
Good evening, everyone. I'm really excited to have you all on today. Thank you, Madam President, for that wonderful introduction. And I feel like I'm home. So I know I'm amongst friends and family and sorors. So I'm excited again to share the knowledge that I have been blessed with and really wanting to focus on how do we set ourselves up for not only a successful financial picture today, but a really successful financial picture for legacy and generations to come. So a lot of what we'll share today will be some of the basics, but we don't want to just talk about how do we make sure our credit's strong or our budgeting is right, but we want to talk about strategic and monumental change, right? So we often know what to do, right? But the matter of the fact is that sometimes we need a little encouragement and we need an accountability partner to get us on the right track. So looking forward to the presentation. And I would love for this to be interactive. There's a couple of sections. So I'll stop and pause after each section, but there will be an opportunity for you to ask questions in the chat. And then we'll also stop to have you come off mute and ask questions as well. So don't forget those questions, all right? Just put them in the chat, write them down. But I want you all to be ready and be engaged. And I will share my screen. And as I do that, would love to make sure that you all know that Sora Nicole is watching this chat for us. So 1 second. All right. Are you all able to see my screen? Yes. Okay. See everyone. All right. So we're going to talk about a couple of things, but I always start with these intro conversations because we could easily miss the big picture. It's not just about money. We know a lot of people that whether we read about them or know them personally that have money, but no peace, no joy, no friends. And that's not what we want at all. So we really want to talk about what role does money play in your life? And it could be that it's just to manage my home. It's just to manage what I need for my children, but it doesn't drive what I do. I want to live with passion and purpose, and that's the key. So we want to think about money as a resource, right? You might think of it as, I want to have a family that values education. So we know we need to save for college and talk about college. I have a family that values entrepreneurship or ownership. So we want to think about, how do we become business owners? So it's so important to think about, how do you think through money, what you've been taught as a child, what your family thinks about money, and then what might you need to change. Sometimes that's a big barrier. How should you rethink or reconsider some of the things that you've been taught as a young person about money? So we are in the business of helping individuals achieve their life goals, enrich their lives, and the lives of their legacies. So when we talk about money and managing your finances, we cannot skip the fundamentals. So I'm going to tell you a story. I had a client that had come to us. She had rolled over an old 401k, and we created a financial plan for her, budget, looked at how she was spending, had recommendations on an emergency fund, paying off debt was a goal of hers, and of course, retirement. So we create this great investment strategy, stocks that we all love and know of, doing well. She skips a fundamental step, no emergency fund. What happens? An emergency. And what do you think she does? She has two options: accumulate more debt, go into her credit card, or liquidating some of her investments to take care of the situation that needed the money. So some of us on the call says, I would have gone to my credit card. But you know what credit card rates are around now? 13 to 26%. And as you all know, the market's down. We're in an inflationary environment, the war in Ukraine. So the market's not paying you that much right now either. So if we had set aside that cash, it's boring, it's not exciting, I know. But if we set that aside, the two options of going into debt or selling my investments would have not been on the table. So I really stress everyone taking time to pause and just make sure that even if you have a lot of student loan debt, even if you are managing your credit cards, or if you're just set, you're just wanting to make sure everything is going well, make sure you have a rainy day fund, an emergency fund. It's important regardless of how much money you make. And it could be you're starting off at 1 month of expenses, and then 2 months, and then 3 months. But I really encourage you, especially in this day and age, to have at least 3 months of expenses in a high yield savings account, like an Ally or Capital One 360 or something, giving a little bit more than some of the traditional brick and mortar banks. All right, so some of the other fundamentals: personal life insurance. On all of our social media pages, we even get texts about this. If someone passes without thinking about a plan, we're trying to gather monies from all of our friends, all of our social networks, to pay for someone's funeral. This should not be an expectation. We can be proactive in having enough life insurance to cover our untimely, or we've lived a long life and we've transitioned and passed. So outside of that, there are many other types of insurance. Disability, accidents happen, long-term care, you live a long life, you will change your mobility. So we also want to think about, how else can we protect ourselves and our loved ones from trying to care for us while we are aging, hopefully gracefully, but there are a lot of things that we can do to make sure we're organized and doing the right thing. The last three are what we'll talk about more in depth: retirement and succession planning, real estate ownership and passive investment income. And then the last is gifting and educational savings. So when I think about the core mission and value of our firm, it's building a legacy. We're multi-generational wealth management firms. So that means we're not just thinking about your life until age 100, but what does that mean for your children? What does that mean for your grandchildren, their children? When we think about our legacy, it's also how we live today. So how were you stewarding the resources you had in front of you? And then over time, how are you teaching future generations to steward those resources as well? So this is a little bit about myself and my family. And, why am I able to come in and speak in front of you right now? So as Madam President mentioned, I am a certified financial planner. And being a CFP was an ultimate significant goal of mine, huge sacrifice. And when you think about designations and what they mean, for me, number one, a CFP is a fiduciary. So that means when I make recommendations, I'm acting in the best interest of you. And I not only have a lot of hours of continuing education to make sure that I am on top of the newer changes in regulation and make sure we're protecting all of our investors, but also how are we planning for life events? So I'm not behind the ball at all. It's always in front of it and seeing those changes. And there are very few women and fewer Black women that are CFP. So I always make the call to say, if you know someone interested in finance or may be strong in math or teaching others, please send them my way, because we need to make a much better increase, I should just say, the number of Black CFPs that we have and Black women. So accredited investment fiduciary is another designation of mine. I'm also a ESGK certified advisor, which means when you think about how you invest, educational types of investments, I would not like to invest in private prisons. I don't want to invest in this. That's called environmental, social, or governance-based investing. And I have a certificate to help 401k managers and businesses incorporate that type of thinking in their workplace. So as you see, there are a number of awards and accolades that I have, and I'm really grateful and thankful for our great clients and being able to do the work that I love. So when you think about our firm, Master Plan Investment Group, we really work with families, businesses, and organizations, including nonprofits. And also we have an educational wellness program. So when we think about how do we help all these groups, the core of it is that we're providing education and we're providing advice. It's important that you're working with someone and you're on a journey to learn more about your investments, learn more about building your wealth, not just letting someone else do it for you. You want to be active. And that's one of our core goals. So now we're going to just, again, start on the basic level. How do you manage your income and expenses? So I'm going to play, sometimes these have a mind of their own, a quick video. And
coming up with a plan is one of the most important things you can do to set yourself on the path toward your retirement goals. But like many people,
sorry about that.
You might be unsure how to get started. Let's take a look at 3 financial planning steps you can put into action today. Budget. Taking a close look at how much you earn and what you currently spend your money on is the first step. What are your essential expenses like rent, groceries, and transportation? Next, determine your non-essential expenses, going to the movies, a cup of gourmet coffee. See where you can cut back and write it down or enter it into an online budgeting program. This will allow you to see what you have to work with and where you can make smart choices about your financial future. Save. Now it's time to tuck some of that newfound money away. Remember, it's never too early or too late to start saving for retirement. An IRA or your company's 401k plan is a great place to start. You'll enjoy some tax benefits, and your company may even reward you by matching a portion of the money you invest in your 401k. That's right, free money to help kickstart your retirement piggy bank. Invest. The investments you choose will depend on your age, your tolerance for risk, and when you'd like to retire. But don't worry, you don't have to go it alone. Retirement plans like 401ks usually offer investments called target date funds, professionally managed mutual funds that take the guesswork out of investing. A financial advisor can help you through the decision-making process. Budget, save, invest. A plan to help you make smart retirement choices today. Your future self will thank you.
All right, so budget. Who has a good budget that they stick with? All right, I'm waiting for some hands. I see, so Sharon has a good budget. Who else has a good budget they stick with? All right, I see a couple others. So if I were to ask, how long were you good at keeping and sticking with your budget? Some people might have said right away, as soon as I made my budget, I was able to stick with it. But most of us, myself included, it took time. And the reason it takes time is because when you think about where your money goes, it's not always up to you. If you have children, you can't neglect them. They have to have their needs met. If you have a car, gas prices, we can't control. We know we need gas. We may be able to control how much we're traveling, but if we're going to and from work, that's a necessity. Groceries, we all have to eat. So there's some things we can control, but we can't always have everything under control. So what we want to do is think of percentages, give us some wiggle room. So I'd like you all to take a quick piece of, or a phone might be right there. Get out your phone, see if you have an idea of your monthly budget. And you'd be surprised the number of people I talk with that say, I don't know what I spend a month. I just know it's enough, right? I don't overspend. But if you don't have a number in the back of your head, it doesn't have to be exact to the penny, of what your expenses are like per month, then I really want you to take, before this event is over, get an idea of what that number is. And don't forget, I use myself for example, don't forget your hair, don't forget your nails, your brow, massage, self-care, all those things are important. So I want you to know what is your budget or what's your expenses for the month. All right. When we think about why that's important, it's important for so many reasons beyond just making sure you're managing your money today. But even when you think about planning for retirement, if you don't know what you spend today, it's nearly impossible to figure out what you are going to spend in retirement. All right, so this is a basic budget template. We're looking at your income, and it could be paycheck one. Other may be a passion of yours. Maybe you are someone that has created crafts and you sell those. You might have a consultation type of service and you make income from that. You may be developing a business, but think about your other income pieces as well. Total that up. On the right side, then think about your expenses: housing, utilities, healthcare, student loans, other types of loans, car payments. So really think about, and then most people say, why do I pull out my estate taxes? What does that matter? It's in my mortgage. But if I'm doing what I'm supposed to do as a friend, or a sister of yours, you should have your home paid off at one point in your lifetime. And you're not going to then have a mortgage. You'll just be responsible for paying your property taxes and your homeowner's insurance. So many people don't really pay attention to their estate taxes, but it's really important. So jot down and make sure we know how much you're spending a month. And one thing I like to say about vacation, I love traveling. I know by the names on the list, you all do too. So if you have an idea of what you spend per trip, and maybe you take 2 trips a year or 3, maybe 2 big ones, 1 smaller, have an annual goal for your trip. And once you do that, break that number into 12 months. So maybe if it's myself, a family of 4, I have to buy maybe 1 flight per year for everyone. The other trips you may drive. So that may be a higher number than someone whose children are older and they don't always travel with. But divide that number by 12, and that should be what you're saving every month so that your travel bucket is full when you're ready to take your trips. So you're not going to go into debt that you don't necessarily pay off right away when you return, just for your travel. So that's one really important piece I don't want you to forget, because it's important. We need to travel. We need to enjoy life, because you can't just save for retirement and not enjoy your journey. So when we think about transitioning from budgeting, what's the alternative? Oh, I don't keep a budget, Kenita. It's just impossible. So you're going to rely on credit cards. So if you're not able to just manage what you're spending, what I find is that most families share with me that they have too much in cash. So that means their money's just lazy. They're working hard for it. They're sacrificing. They have so much in the bank because they're not sure what they should be spending. So they're comfortable with buffers. So then they're losing out on growth, or they're using credit as a buffer. or credit cards, which is very dangerous. So when we think about credit, and this may be very basic for some, but your credit score is really important. And for those of us that have children, you are able to put your child on a credit card of yours with a strong payment history. Don't put them on a card that has had some missed payments or the balance is very high, because that's going to impact their credit negatively. But if you add them to a credit card that you've been paying on consistently, they will graduate with a very high credit score that they don't know about, but they will thank you for when they're trying to begin their credit history. So when I think about the next section here, annualcreditreport.com is your go-to every year, okay? And why this is important is because the number of fraudulent cases that I hear about, people opening cards in someone else's name or getting a loan in someone else's name. If you check your credit report every year, you'll see this in advance and we'll be able to be proactive in stopping it. So now I want you to think about a story. So when I used to live in California, for about 5 years, I lived in LA. And I had moved from one town to another, knowing I was coming back to New Jersey. I said, I need to get to the sun. So I lived in Santa Monica. And before, I think probably a month after I moved, I noticed on my credit report that the electricity company, it wasn't PSE&G, I forget it now, had an outstanding balance for me. And I had moved from the place. I know I closed the account. I didn't understand why. So the next tenant had, for some reason, transferred their account and it still was in my name. And they were running up their bill and not paying it on time. If I didn't check this annualcreditreport.com site, which is free, I would have missed it for months and may not have had the information that I would have needed to prove that I had left and it really wasn't my account. So this should definitely be a part of just your annual financial spring cleanup time. All right. And as we know, there are 3 credit bureaus: Experian, Equifax, and TransUnion. And they all are a bit different. Some are more heavily relied on for mortgage assessments, looking at your credit score. Some are more used for car debt. But the idea is that you want to check all of them. And if you have a credit card, usually they'll give you the score for each of these or the main one, because every month they receive it. So if you don't have it already, just ask one of your credit card companies. So the FICO, your credit score, is broken down in a few different sections, and the majority of your score is based on your payment history. So if you miss a month, that's really going to impact your credit score. So if you are able to, automation, just make it automatic. Okay, so I'm going to stop here because we've gone through 2 sections and just check to see if there are any questions that Sor Carmichael wants to share.
I do see one question. Please mention the names of the 2 high yield savings accounts again, please.
Okay, sure. So the 2 that I often recommend are ally.com, ALLY.com. And there's a section on the site that says high yield savings. And the other one is Capital One 360. So like your credit card or the credit card company, they have a high yield savings. And the reason the yield is higher than maybe a Bank of America or PNC or credit union even is because they don't focus on brick and mortar. They are able to give you a higher yield because it's just online. So you may keep your emergency fund there. You may keep your bulk travel fund because you're not moving that money often. And if you look at what you're getting on your savings in your bank, usually it's a 0.001 or something. And go online and just compare it. And generally they're about 0.5%. So 0.5% is better to me than 0.001. So I always like to say I work really hard for my money and I want my savings to work hard too.
Great. Another question. What age is allowed for adding your child to your credit card?
Good question. It's not, so most people think, oh, they have to be 18. You can add them at a younger age. So generally we look at around 15, 16 years old. Okay. Any other questions? And that's really good. You don't have to tell them because you don't want them to be, thinking, you don't want to think about accumulating debt. But what they're going to do is graduate with a strong credit score.
Okay, I do see another question.
Sure.
Advice about going about closing a credit card due to the APR not allowing you to save adequately.
Good question. So what I often hear is if I have a credit card that maybe I paid off or I haven't paid off, I'm working on paying it off, should I close it just to help me not reaccumulate debt? So because, as you know here, the length of your credit history, that third section, if you close your account and it has a long history of you making positive payments or even negative payments in some cases, but it's your longer history, it's going to hurt your credit score because you're cutting off some of the history that the bureaus use to assess what type of lender you are or what type of borrower you would be. So if you have one of your oldest cards, keep it open, don't close it. But if you do have to close it, just recognize your score will go down for a period of time. It will come up, it will recover, but it will go down. So you may want to take care of anything that you need to in advance to allow it to come back up if you are planning on closing a card. Another thing to be aware of, some people tell me if you don't use a card for a certain period of time, then they'll close it. So you may have a certain point system or you like to get rewards. But if you have an automatic buy on, let's make up usually your phone bill doesn't vary that much, but choose a bill that doesn't change often. So you can, at the same time, establish a payment that's automatic too, from your bank to that credit card, because you don't want to misalign your debt versus what you're paying. And ideally, you want to pay it off every month right away. So
I think that's it for right now. Thank you.
No problem. I was going to say, one last thing I'll add is when you think about your credit, be mindful of the fact that they're using, so there's a change in our culture, right? Has credit been equal and fair? No. So there may be shifts in what these numbers mean and how to evaluate them. So just be current on that conversation, because there are conversations about how can you assess a borrower's strength or ability to repay you other than one's credit score. But it is the main way that you're assessed, good or bad interest rates. Okay. So when we think about debt, I want to focus on, just looking at the group, want to focus on 2 stages of life. So if you're young and you may have credit card debt you're paying off or student loans that you're paying off, student loans are a debt that you may have tax benefits on when you're paying the interest. Unlike a credit card, your credit card does not help you at all with taxes. There's no deduction of your interest. So when you think about what should I pay off first? Pay off the credit cards first. And again, we won't have to accumulate debt if we have that emergency fund, but things happen. But the idea is that if you're thinking about where do I put my money, you want to pay off credit card debt first, but don't eliminate your contribution to your emergency fund, because that's really important to avoid more debt. Secondly, like I said, the education debt. Don't forget about the forgiveness options too. So if you have been in public service or if you're in nonprofit work, then you should definitely look at whether your loan may be forgiven in the future and let that dictate how much you're paying over and above your minimum payment for your student loans. Private loans generally are outside of that forgiven structure. So this is more so federal loans that might be forgiven in the future. When you think about paying off debt, so there's a lot of different ways that I've heard of, and people have used the snowball effect, where you're paying off your smallest, your debt first, and then that payment is going to go on the next debt and the next debt. But the point of it all is just you have to have a plan and just be disciplined. And tell your friends so they don't forget and try to invite you to things or do things that are really going to throw you off course. And it'll be a sacrifice, but it will be a relief of stress and anxiety once you get from under the debt. It's very significant. when I think about a few journeys that have been shared with me about getting debt free, it really started off with saying, I'm going to be creative about how I have fun. And I think the pandemic helped us all just get rid of a lot of debt because we couldn't spend money. So we became really creative in how we entertained ourselves. And it was most often at home with small groups. So maybe revisiting some of those things to get from under a lot of debt. Before I go on, I just want to share one thing. When I think about families that are kind of beyond that stage and they're saying, I'm closer to retirement, Kenita, I've learned my lessons around debt. Then people ask me if they should pay off their mortgage. And my thoughts are, when you think about a mortgage, that is a deductible interest generally, depending on your situation. But on the other hand, credit card, you can't deduct the interest from your credit card. So if you're paying over your mortgage, I'd encourage you to shift that extra payment to another debt if you have it. And if you don't have another debt, shift it to your investments. And the reason I say that is because, again, one day your mortgage will be paid off and you'll have your real estate taxes and you'll have your insurance, your homeowner's insurance to pay. And you may be retired, no children. You will have very little to pay, or sorry, very little deductions. So that means your tax bill may go up because you just don't have any deductions. So I'd rather you invest and save and pay off things as opposed to putting a lot more on your mortgage, because that technically is an interest that can be deducted, or if it's high, can be really revisited and refinanced to make it lower. But I'm often not a huge fan of paying extra on your mortgage, but pay biweekly. You can pay every other week, and that knocks off about 5 years in most cases from your mortgage. All right, building an economic legacy. When we think about saving, the goal should be about 15% a month, and you want to spend no more than 70% of your income, and you want to invest at least 15% a month. So when we think about saving versus investing, so I have children, so college saving is a part of my saving, emergency fund, regular investing. So there, it goes a couple of different ways, and retirement. So it's not always the same for everyone, but these are some rules of thumb, but it's different for every person. Okay, so I'm just checking time. So before I jump into the investment piece, I want to talk a little bit about real estate. And these are our Facebook and LinkedIn social media pages. And I want you all to follow, because what we're going to start doing is talking to families about how do they build education and positive money management practices in ways that can benefit their children. Some of you have reached out. I have this, my son or my daughter is, graduating soon or recently graduated. They really don't know what to do, but when I tell them, they don't listen to me. So I want to make sure we're focusing on how do we help those young people too. So when we think about investing, it definitely starts with us learning. We can't just be passive investors. We have to be active. And we want to set a goal, know what our style is, and watch what we're investing in. So by show of hands, who's watching their investments right now? Probably, I don't think I would if I wasn't my profession, because the market is very volatile. And we're going to talk about that in a second. But what happens is when we have volatile markets, we often are concerned and afraid, and our emotions may take control, as opposed to our recognition that the market works in cycles. We'll get through this. We have to first have a plan, understand the plan, and stay invested and add more. So we're going to talk about that too. So if the more comfortable you are and knowledge you have about investing, this doesn't scare you as much. Gives you a little concern, but this is an opportunity. So we have stocks as ownership opportunities. We have bonds that still allow you to have income in different phases of life, but it's more conservative and is less volatile than stocks would be. Mutual funds tend to be a way to invest in both stocks and bonds, but letting someone else drive the car. They're able to choose what types of investments are in the fund and move them around as they see fit. The last piece at the bottom, exchange traded funds, write that down. Index funds, alternatives, those are also really good investment options that many people overlook. So one term that I want to highlight is called asset classes. So an asset is just something you own. Real estate is an asset. Cash is an asset. Stock is an asset. So all these are assets, and they all have categories. They're just classes. That's what they call them. So we have categories of stocks, categories of bonds. These are the main three that we'll talk about: stocks, bonds, and cash. The higher the return, usually the higher the risk. The lower the return, the lower the risk. All right, so my favorite part of investing is the stock market. I enjoy just learning about stocks and understanding how they work, because ownership, if you think about wealth in this country, is how most become wealthy, how most maintain generational wealth. It's owning your company, owning stocks. You're an owner, you make the decisions. So when we think about the sectors of the market, they're listed here. So financials, materials, real estate, healthcare, industrials, consumer staples, consumer discretionary, telecommunication, energy, utility, and information technology, or IT, are the basic sectors of the market. You can buy an exchange traded fund or some type of investment with each of these little slices of the pie. You can buy one, you can buy a bit of all of them, but the market and the investment vehicles have become so diverse that there are many, many options for you. So the most common terminology when you think of the market change that we hear about is the S&P 500, or the Standard & Poor's 500 is what it's fully called. And it's 500 companies, but most of us hear about the Dow, actually, the Dow Jones Industrial Average. So the S&P 500 are, again, 500 companies. You can Google it and it'll tell you each of those companies. And they're usually really large companies in the States, in the US. All of these are US companies. They may have investments or business outside of the country, but they're all US based. So I'm looking at this entire list: Adobe, Alphabet, American Airlines. I'm sure you know each of these companies. Many of you may not have known that Chipotle is actually a publicly traded company and a stock that you can buy. Etsy, PayPal, Nike, all of these are companies you could buy. And the idea is that when you start investing, first start with a company you know. And over time, we're going to talk about how might that change. So the next set of companies are the Dow Jones Industrial Average, the Dow. Another set of companies, just 30 though, that I'm sure you know. So if you choose one off of this list, actually choose two. I'll choose United Healthcare Group, and I will choose Microsoft because I like Microsoft. Although I have an Apple, everything else is Microsoft. I have Microsoft laptop too. So I like making sure we're diversified. So the reason I chose United Healthcare Group is, regardless of what's going on, we have to spend money on healthcare, young, old, and in between. So the second piece, Microsoft, I like them because not only are they very comfortable and familiar with the retail, regular individuals, but they also work with corporations. So they're both sides of the spectrum. So those Apple users, it's a huge following of Apple users. So that might be another third if I had to choose three. But I have to make sure I don't put all of my eggs in one basket. So too much technology will mean that if the technology sector is going down, like it has been the last couple of weeks, then most of my portfolio will be down. So if I can diversify, that's going to protect me from being what's called concentrated in one area. So I might have some healthcare, I may have some technology with Apple or Microsoft, and then I may, if I don't mind, a Visa, which is a financial company, or a MasterCard, which is just like a Visa, or PayPal. So they're different types of companies, but I'm diversifying. So many of you think about, where do I find this money, Kanita? How am I going to invest? And you're already invested. Just realize that if you have a company plan, your 401k, you're in the market. So it's going to help you to invest and learn more about it. So if we just think about that expense worksheet that we did a few slides ago, we can find the money. And the best idea is to put money in an account every month, what's called dollar cost averaging. So write that down, DCA. Dollar cost averaging means you're putting in your money a little bit at a time, regardless of where the market is. So if you can see my cursor, you're putting your money when the market's down, you're putting in the money as it goes up, you're continuing putting your money. So you're buying at different highs and lows. But if I said, you know, buy something now, today, actually 2 days ago, the market was down much more. Most of you would have said, no, thank you, Kanita, I'll wait until it comes back up. But then you would have missed the sale. Someone called you, there's a friends and family sale at Macy's, you would have missed it. So the idea is that we want to get that friends and family sale, but that's the time where you really don't want to go to the store. You don't want to buy stocks, but that's the best time to buy them. Because what happened, I think some companies I was looking at the other day, they're up about 17% because they were down so much a couple of days ago. So if you know you're committed, this is a good company, why not buy it if it's on sale? All right. So when we think about the market, we know there's risk, but there's also opportunities. But the idea is having a plan before you jump in. So one way to balance that jump is having a mutual fund or an exchange traded fund. And that means you're not just choosing Apple, you're not just choosing Microsoft, but you're getting a basket of different things. So my mother's from Georgia. So Coca-Cola, that's a publicly traded company. Dasani Water is a Coca-Cola publicly traded company. So I may have Coca-Cola in my basket. I may have Frito-Lay chips. Mondelez is the company that manufactures and makes those chips. When you think about other companies, you know, everyone has groceries to buy across the country, across the world. So some companies are going to be stable, even if the market's down, because we all have to eat. So those are called consumer staples. So it's not like technology. It may not grow substantially like an Apple, but it's going to grow because we still eat and we eat again. So the idea is that you want to make sure you're invested and you're learning about what you're investing in, you're diversified. So this area, most people don't talk about the size of the companies they buy, small, medium, and large, but it makes a big difference. So if you're a small business, your goal is to become a large business. And that growth is what me as an owner can take advantage of. But if I buy a large company, they may grow, but they may not grow the same amount that a small company would as it becomes a large company. It's more risk because they're smaller. They could just not grow or go out of business. So you want to diversify, not just in what types of companies, but the size of the companies too. All right, so again, why diversify? This is a confusing chart on purpose. It's called a jelly bean chart. All of those asset classes that I showed you before, the performance, the money that you make is different every year. So last year, large companies grew by the most, small companies, small cap, or follow that growth. Emerging markets was third in line. So the idea is the highest return is never the same every year. And that's why it's important to diversify. Okay, so I'm gonna skip around. Just wanna make sure we have a lot of time for questions. So when you think about how should you invest, it may be that you're an aggressive person as far as you want your money to grow. But if you don't have a lot of time for your money to grow, then you shouldn't be as aggressive, because you could invest and then a war in Ukraine starts. No one could have planned that. So the idea is that you want to be able to say, I have a couple of years. So if there's a war, if inflation is a concern, if our economy is down, I can still invest and not have to take out my money, and it can recover. But if you invested with only 2 years to spare, this is a really tough time for you. So you want to be more conservative if you don't have a lot of time, and a lot meaning at least, 3 to 5 years. Just wanted to touch base on cryptocurrency. It's a lot here. There's Ethereum, Bitcoin. There's so much, so many ways we can go with this topic, but I want you all to just think about it as a type of company that you can use, really an asset class that you can use to diversify. Most people said, oh, it was an alternative, meaning it's not like, it doesn't move like the stock market, but it actually does. So it's not an alternative. It's actually just another way to invest. And if you're new to cryptocurrency, I would encourage you to watch some quality videos and just information about Bitcoin, cryptocurrency, to learn about it first. And then consider whether it's appropriate for you. It's risky. It's definitely risky because it's new. And the earlier investors made a lot of money. Think about it. And then those that are coming in later, they still have made some, but maybe not as much as the earlier investors. So learning is really your best opportunity now. So when you think about cryptocurrency, it's just like a currency. Like we buy and sell things with our dollars. If we were in Japan, we buy and sell things with a yen. But it's another type of currency that's kind of international, if you will. So there's an intermediary. If I go to, if I go to China and I arrive, I want to change my money at the airport, then I will go to one of the exchange booths. That's also a way to have access to cryptocurrency. So you can buy the exchanges, meaning I have dollars, I want to exchange them into crypto, or I have crypto and I want to exchange it into dollars. Those platforms make money too, because the exchange, the house makes a transaction fee on every move in and out. So that's another way to invest in cryptocurrency without choosing the currency, because you're still learning. And regardless of what currency you have, you still have to use an exchange or a wallet, it's called. So that's often a good starting place. So when you think about the wallet, there's several wallets. Coinbase is a pretty popular one, but you're basically able to exchange your currencies into other assets like dollars or traditional currencies. There are debit cards. This is quite surprising how things have grown so quickly, I should say, in the use of cryptocurrency. Some people get paid in it, but they're debit cards, and it's not going away. It's just going to be a matter of how do you, if you choose to, incorporate into your portfolio. All right. So I'm going to touch a little bit about retirement, and then I'll move on from here for questions. So when I think about retirement, actually, I think there's some more questions. I'll go back for a second. Oops. All right, I'll stop there. Can you let me know if there are any questions in the chat? Sora?
I only see one. What do you think about the D-free approach?
So the D-free approach is, I took it years ago. I'm trying to think of how long. I don't think I've even had kids at that time. So over 7 years. So it was a long time ago. But the concept of being debt-free is a good one. I think it's born out of recognizing that certain communities weren't taught about debt. And we have kind of overlooked the importance of saving and growing and having cash, and just taken on debt and when you're replacing the value of cash. So I feel that a lot of the principles of low debt, having cash, using cash is really good. However, I also recognize as an investor the opportunities that leverage, which is debt, provide. So for example, I know one major component of D-free is having zero debt, but I don't necessarily think that, for example, mortgages as a form of debt are terrible. Because when I look at the interest rate, for example, of the debt, and at some people I've seen 2% interest rates on mortgages, versus being able to make even 5% in the stock market, that's a 3% spread. So I feel that it's a very good concept to have, meaning low debt, have cash, emergency fund, and then that allows you to graduate to investing and expanding your investment portfolio. However, at the same time, for years, this country has allowed individuals to really prosper by owning land, owning real estate. And I think the different levels of wealth are incorporating that type of investing. And if you're debt free, you won't move as quickly in some of those areas because having $300,000 or $500,000 isn't, that easy to accumulate. But leveraging, having good credit, having real estate with tenants, or buying a duplex or 4-unit building and you living in one and collecting the rent from others, that's debt, but it's a smart way to use debt. So I think that D-free is a great concept because it helps us manage debt that may not be ideal for us. However, I find it's challenging with the house piece, because I think too many of us sell our properties and our homes way too soon. So it's not as simple, I think, as it is presented when it comes to real estate specifically. Hopefully that was clear enough. All right, so retirement stability. I don't know if you can hear Bella sing in the background, but retirement stability. This is really important. And I wasn't taught this as a young person. My mother and father weren't taught this. So some people were, which is great. But if you weren't, there is the ability to, again, impact our legacy by sharing this with someone else. So when I think about retirement, I don't want to position myself to have and pay just as much taxes as I'm paying now as I do in retirement. So it's important to think about Roth IRAs, or how do I build an income that's not fully taxable as well. So Social Security for those that are kind of 40 and younger will look different than those that are over 40, because the program is underfunded. So there's either going to be a requirement that you work longer or you get a little less. So don't rely on Social Security if you're under 40 the same way as it is presented on your SSA.gov statement. So one thing I want you to write down for this section is SSA.gov, Social Security Administration.gov. Everyone has an account. I have one too. I go in there once a year, and it'll tell you how much you'll receive at 62, at 63, at 64. So you know how long or short is this part of your school. And we all know it won't be enough, for us to retire comfortably. However, it'll be a portion of our investments. So the other piece is personal savings. That's my 401k, my 403b, my TSP, deferred compensation. The bulk of the savings, the longer, if you will, of the three will be that part. And the last is pension and passive income. So because we're in New Jersey, some of us have, and especially where we live in New Jersey, some of us have pensions that we're expected to have as part of our income. And that's wonderful. Some of us do not. So when we think about how do we prepare, if you do have a pension, make sure you know what that number is. Pay attention. Because if you put together that budget we talked about in the beginning and say, I want to have just as much money as I do today as I would in retirement, that means you're trying to replace the same paycheck, knowing inflation is going to impact that, but try to have dollar for dollar as a start. So we have Social Security, number one. Number two will be my pension, or if I have property, I don't have a pension, so it will be my rental income. I'm paying off these houses, so it'll be just be my real estate taxes and my insurance. So, but rental income minus those two things. So how much is that going to give me in retirement? What is a shortfall? That gap has to be filled with your 401k and your 403b and all those savings accounts. So you can't just put it in cash. It's not going to grow enough, but you want to be mindful of what your risk tolerance is, because the opportunity is great, but you have to be mindful of what's the right area for you. So when we think about passive income, try to think about rental properties or maybe other businesses that you may have royalties from, but really think about, how do I create a passive stream of income in retirement? And remember, you're retired. So at 75, you are not going to get a tenant's call at 2 a.m. saying the pipe's leaking. So you have to have some cost for a property manager. So think about those things as well. But when I think about retirement planning, we really want to focus on who, what, where, when, why, and how much. So when we think about that, I'm not going to play this video, but we think about that, it's important to consider several different factors. I'm just going to use the visual. The idea is that we want to, again, know not everything is taxable if you're using a Roth as income. If you have a 401k, then that will be taxable if it's traditional. So we want to think about all those things at the same time, and that seek professional advice if you're trying to work, organize yourself and get it under one roof. So the next thing is, don't miss your company matches. So if anyone has a match or you think your employer contributes something, find out what that is. And if you don't know, and once you find out, I want you to add that to what you're contributing. So in this example, if you're contributing 6, your employer contributes 3, you're further along than you thought. So you're actually contributing 9% to your retirement goal. And if the goal is 10, if the goal is 15, you're closer than you thought. Okay. So when we think about, let's go to the next.
Meet Emily.
Oh,
Emily.
we're not going to do Emily today. So when we think about retirement plans and how to manage it all, there are many options, but I really want you all to spend some time, especially if you have a 401k, think about this Roth option in your 401k. So that just means you're going to pay taxes first and then put your money in the account. Pay taxes first and then put your money in the Roth. You can also have a traditional 401k and have some of it go to the pre-tax bucket and some of it go to the after-tax bucket, which is the Roth bucket. And that's important because think about it. If you put in, let's say, make it simple, $10,000 a year, and that $10,000 grows to $20,000. The $20,000 grows to $30,000, up to X, let's say $1 million when you retire. If you put it all in a 401k that's traditional, all of that money will be taxable as ordinary income when you begin taking distributions, when you start taking the money out. On the other hand, if you had a Roth or even some of that money in the Roth, and remember, it's growing. So all of that's growing tax-free. All of it's growing tax-free or it's growing taxable. But if I have all of my or more of my money in a Roth, I'm not paying taxes on the distribution on my income. So today I may not get the tax deduction, but down the line, when I don't have children, my homes are paid off, I won't have more taxes to pay. So it's sometimes best to think about which is right for you or what combination is right for you. Okay, I do want to play this and then we'll stop because it's 8 o'clock. Wow. All right, last one.
Most people are familiar with the advantages of a traditional 401k, where you can save money for your retirement before it is taxed. This helps reduce the taxes you pay today. Instead, you pay income taxes during retirement when you withdraw money from your account. A Roth 401k operates in the reverse. You make contributions to the Roth with money that has already been taxed. The upside is that you don't pay taxes when you withdraw money from the account later on. So the key difference between traditional and Roth is when you pay taxes on your money. You have a choice: make tax-free contributions now or receive tax-free withdrawals later. Here's a simple way to look at it. A traditional 401k means that you pay income taxes on withdrawals. A Roth 401k means that you pay income taxes on contributions. How do you decide which approach to take? The goal is to pay less money in taxes, so consider your current tax bracket and whether you think it will be higher or lower during your retirement years. The general rule of thumb is that if you think your tax rate will be higher when you retire than it is now, a Roth contribution may be preferable because withdrawals will be tax-free. But if you're betting that your tax rate will be lower in retirement than it is now, a traditional 401k contribution may be more suitable because you'll pay a lower tax rate on the money you withdraw. People in their early career may consider contributing to a Roth account because they expect their income to rise over time. That means their tax bracket will rise as well, so they may be better off paying taxes now and receiving tax-free withdrawals later. But if you're looking to lower your taxable income today, a traditional 401k contribution is more suitable for you. A third option would be to split your contributions between a traditional and a Roth account. With this approach, you'll invest your savings in different buckets, which can help diversify your options and give you more flexibility with your income during retirement. Regardless of the approach you take, saving in your company's retirement plan is a sure way to jumpstart your retirement savings.
All right, so I'm going to stop there and just recap a bit and talk a little about what we can do now. It's 8 o'clock. You've been on the call for an hour. What do you do? All right. So some of us are doing really well. We know we made good decisions. We don't have any debt, but some of us see there's some, what do you call it? Housekeeping that we need to do. And I'm not alone. Me too. So the idea is that now that we know, we have to do better. And not only do we have to do better, but we have to help someone else do better. So looking at talking to our children, talking to our community, nieces, nephews, close friends about getting rid of credit card debt, reducing your personal debt, getting a plan together to do it and helping each other take care of that will free up not only stress, not only anxiety, but free up money to invest and grow in other ways. And making sure that we don't overlook the value of owning property, owning stocks, and not just being passive, to this opportunity is also really important. And we have other financial professionals in our community that we can lean on. We at my firm focus on retirement planning and 401k management. So as you're figuring out, trying to put everything under one roof and consolidating, that's how we can help you make sure you're prepared and help you manage your investments as well. But I'm glad everyone was able to join the call. And if there are any other questions, feel free to share. And there's a wrap.
Okay, I do see one more question. Would you ever recommend a lump sum pension plan payment versus installments?
Really good question. So it really depends on really two major things. So a lump sum is usually used if there's some major event or some costs you're trying to pay down, or you're trying to consider, should I roll it over into an investment strategy with stocks and bonds and other things? Or can I get more money by buying an annuity or a pension elsewhere? So the one concern I always say is, if you are getting a pension from a place that you don't think has a strong financial background, meaning could the company go out of business? Could they go bankrupt? Then you want to think about maybe pulling the money out, because there have been companies that has happened. There is insurance that most companies are required to have, but it's not going to be, in most cases, dollar for dollar. If you're going to keep your pension, or you want to compare it to get an annuity, more than likely it's always going to be higher by getting the pension. But if you're concerned, again, about the entity from which your pension will come from, then you may want to diversify into another vehicle. Or if you have other plans, right? Sometimes you say, I was going to get $5,000 a month, but if I buy these 3 properties, not only will I get that $5,000 a month, but my children will have equity to pull from. These other things will take place. So it's all about your strategy and what you're trying to achieve.
Great. Madam President?
Okay, well, I want to thank everyone. I think we said a wrap. Is there a question?
Yes, there's one more question. Hold on. Okay. Thank you. I really needed this information because I'm interested in stocks and investments, but I do not know where to start. I am nervous about losing my money. What do you recommend as a starting point in stocks?
That's a really good question too. So it's very expected that you're nervous, and especially now, the market has been really volatile. But what I would recommend, if you are starting at any time, remember that chart I showed you with the roller coaster? It's the best time to start when the market's low. And it doesn't mean it won't go lower, but it means that you're not buying at a higher point either. So we're in a war. How often does this happen, right? Inflation is at an all-time high. This doesn't happen every couple of years. So there are very unique situations that we're all investing in right now. So if you were to think of any conversation about peace talks, is that going to make the market go up or down? Up. If there is conversation about rebuilding in Ukraine, so just think about all the positives that can happen, and they must happen. War can't go on forever. So we know that there's going to be a turnaround. So when we think about investing, it's a matter of how much time, like I mentioned, do you have before you need the monies to be taken out, or you need the income from the investment. So I believe it's a great time to start now. If you have, again, at least 3 to 5 years, because you have to give this time to turn around. But on top of that, you have to educate yourself. So on our website, we have a couple of really good videos about investing, and I give also other information about great YouTube videos and different organizations that give you quality information. Not everyone that has a video out there knows what they're talking about. And secondly is read. So Apple, for example, Tesla, they're all public company. So they have to share publicly their, it's called an investor call. So they'll tell you, are they expecting to grow? What's going to make them go down? What are they concerned about? Those are things that you can all attend and listen to. So if you're thinking about buying one company, Google that company name or research the name and listen to the investment calls, their earnings calls, and then you'll know a little bit more about them. But it's exciting. I really encourage everyone to invest. And mutual funds or index funds or exchange traded funds are a mixture of investments, like the diversified ones that we were talking about earlier. And they help you not have to make that choice of which one or two, but you're buying the basket.
Thank you. Sora President.
Okay. Sora Bullock, I heard you say something about a prize or a raffle, or how do you want to handle that?
Yeah, so I was going to offer a consultation, a financial planning consultation. And generally our consultations are just figuring out how we can work together, how we can work with you. But we'll go beyond that and just giving you some real guidelines on how much should you be saving for retirement? What are your goals for education savings? It's not a full-blown financial plan, which takes a lot of time, but it's definitely an abbreviated one, which is really good. So I can think of a question from the presentation. So one of the easier ones. What is the recommended percentage of your income to spend per month? I have to go to the chat.
Put your answer in the chat. Okay, Danielle Perry.
Oh, yes, she's right.
All right, Danielle.
All right, yes, you got it right. Okay. So I will, if Danielle, do you all have her email address? Then
Danielle, if you could send your email address to me. I am Georgette Bowman, and we'll make sure that you get in contact with Kenita Bullock so you can claim your prize. Thank you. Well, everyone, I'd like to thank you. Oh, and please, before we forget, please complete the evaluation that is in the chat. Please complete the evaluation that is in the chat. I'd like to take this time to thank Kenita for all her information that she has shared with us. It was an awesome presentation and workshop. Never too early or too late to save. Investments, I'm a little nervous, but I'm going to look more into it. And I also am looking at my investments that I currently have because I'm scared, with what is going on in the country. But hey, it's going to get better. That's all we can hope for. It's going to get better. But I'd like to thank everyone this evening for getting on and participating. And hopefully you've taken away some information that will be helpful in your planning and your budgeting, your savings, and your investments. I'd like to say thank you again and have a good evening.
Thank you.